What if I told you that the very first major crash in Bitcoin history happened in 2011 when the price went from $32 all the way down to $2 in just a few weeks, wiping out 93% of its value and teaching the world a painful lesson that would repeat in every crypto crash since? Yeah, you heard that right. The first time Bitcoin really showed the world how volatile it could be was in 2011 when the price skyrocketed and then collapsed almost overnight, leaving early investors either rich or completely wiped out. If you think crypto crashes are a new thing, or that 2018 and 2022 were the first big ones, then you are about to discover the original lesson that started it all, because today we are ripping open the first crypto crash of 2011 from $32 to $2, the verified story of how the biggest exchange at the time got hacked, the panic selling that followed the lack of rules and big investors, and the deeper reason in this crash set the pattern for every bubble and bust in crypto since. Stick with me until the very last word. Because the documented price explosion, the Mt. Gox hack that triggered the collapse, the human stories of people losing everything, and the chilling parallels to later crashes will leave you equal parts fascinated and warned. If you have ever lost money in a crypto crash, or you want to understand why these bubbles keep happening, hit that subscribe button right now, turn on notifications, so you never miss these deep dives, and drop a comment below telling me which crypto crash hurt you the most, or if this explanation has you seeing the pattern clearly for the first time. I read every single comment, and we are building this conversation together as a community that refuses to let history repeat itself without learning the lesson. Welcome to Money's Hidden Past. Rich people lied, we fact-checked. Let us travel back to 2011 when Bitcoin was still brand new and exciting. The cryptocurrency had been created just 2 years earlier by the mysterious Satoshi Nakamoto, and it was still mostly known to a small group of tech enthusiasts and libertarians. In early 2011, Bitcoin was trading around $1. Then suddenly, it started to rise. By June, it had reached $32. That felt like a fortune back then. People who had bought at a few cents were suddenly seeing massive gains. The excitement was electric. Forums and early social media were filled with stories of people quitting their jobs to trade Bitcoin full-time. It felt like the future of money had arrived, and anyone smart enough to get in early could become rich. The price kept climbing and the hype grew. Everyone wanted a piece of this new digital gold. Then, in just a few weeks, everything changed. The price collapsed. From $32, it dropped all the way down to $2, a 93% crash in a matter of weeks. It was brutal and fast. Most people lost almost everything they had put in. The dream turned into a nightmare overnight. This was the first crypto crash, and it set the template for every major crash that would follow in the years to come. Why did it crash so hard? The biggest reason was the hack of Mt. Gox, the largest Bitcoin exchange at the time. Mt. Gox was handling the majority of Bitcoin trading worldwide. It was the go-to place for buying and selling. In 2011, hackers broke into the exchange and stole hundreds of thousands of Bitcoins. The news spread quickly and panic set in. People started selling everything they had. The selling pressure became overwhelming. There were almost no real rules or big institutional investors back then. It was mostly regular people trading with very little money and even less experience. When the panic hit, there was no one to stabilize the market. The price free fell. Margin calls and forced liquidations made it even worse. The classic story of a bubble played out in real time. Wild excitement, overpriced coins, then total fear when reality hit. The human cost was real. Many early adopters who had put their savings into Bitcoin saw their money disappear. Some people had borrowed money to buy at the peak and were left with huge debts. The crash wiped out fortunes that had seemed so secure just weeks earlier. But here is the part that always repeats in these bubbles. The early smart investors who sold at the top walked away with big profits. They had bought low and timed the exit perfectly. The latecomers who bought at the peak lost almost everything. This is the classic pattern of every bubble. The smart money gets out early, and the public gets left holding the bag. The energetic parallel that makes this story so important is how this exact pattern has repeated in every major crypto crash since. In 2018, the market crashed from almost $20,000 to $3,000. In 2022, it crashed from $69,000 to less than $20,000. Each time the story is the same: wild excitement, easy money, FOMO buying, then panic selling when the bubble pops. The reasons are different on the surface, but the human psychology is identical. Greed drives the rise, fear drives the fall. And the people who understand the cycle profit while the masses lose. The deeper lesson from the 2011 crash is that Bitcoin taught the world very early that prices can go up insanely fast and crash just as fast. It was the first real lesson in crypto volatility, and it has been repeated many times since. The crash showed that when there are no rules, the market can swing wildly in both directions. There were no big regulations, no institutional safeguards, and very little understanding of how this new asset worked. The crash of 2011 was the wake-up call that crypto was not going to be a smooth ride. It was going to be a roller coaster with massive ups and even bigger downs. The people who learned from it became the ones who survived the later crashes. The energetic reality check is that we are not smarter than the people who lived through the 2011 crash. We have better technology, better data, and better tools, yet we keep falling for the same trap. The crash of 2011 did not end speculation in crypto. It simply taught future generations how to do it bigger and faster. Every modern bubble carries the DNA of that first crash because the underlying forces are identical. The only real protection is remembering the lesson that value is not determined by hype or crowd belief, but by fundamentals and sustainable use. When something is priced based purely on the greater fool theory, the crash is not a matter of if, but when. The 2011 crash was the world's first crypto crash, but it was also the first warning, and we have ignored that warning at our own peril. The mature recognition here is that the 2011 crash was never really about Bitcoin alone. It was about human nature, the dangerous cocktail of greed, easy credit, and collective delusion that turns ordinary assets into financial weapons of mass destruction. The people who lived through it learned the hard way that when prices detach completely from reality, the fall is swift and merciless. We are still learning the same lesson today, only the stakes are higher and the crashes are global. The next time you see an asset class exploding in value with no underlying fundamentals, remember the people who bought Bitcoin at $30 in 2011 and woke up with almost nothing. History does not repeat, but it rhymes, and the rhyme of the first crypto crash is still playing in markets around the world right now. If this deep dive into the first crypto crash of 2011 from $32 to $2 fired you up about seeing the timeless pattern of bubbles and human greed, then do me a favor right now. Smash that like button to let the algorithm know this conversation matters. Share this video with every friend and family member who needs to understand why history keeps repeating the same painful lesson, and let us keep exposing what they do not want you to see. I will catch you in the next one, where we break down the next hidden chapter in the history of financial madness. Until then, stay informed, stay skeptical, and remember that when prices rise faster than reason, the crash is already on its way.